Hi, everyone. Good morning, good afternoon, good evening. Welcome to the third call of the mentorship session of the CMT Association's Investment Challenge. Um, it's a pleasure to have everyone again here. I can see that we're live. Our session has now started. We have Dave, Prasenjit. Oh, Chris has joined us as well. Let me quickly add Chris to the stream. Hi, Chris. Can you hear us?
Morning, I can. How are you guys?
Hi, Chris. Good morning. So we have almost a full house now. I just started off the call. We have a few audience members who have already started viewing live as well. So let me not waste further time. Let me just hand over to Dave and Prasanjit to quickly introduce themselves and then let the conversation flow based on whatever questions you all have for the mentors as well. Can I ask Dave to start off? Dave, could you just give a quick introduction about yourself? And then Prasanjit can take over from there.
Okay, thank you so much. Well, welcome everybody. I hope you all having a nice day. I just got up. I'm from Boston, Massachusetts, in the United States, so it's roughly 7 o'clock in the morning. So I'm still shaking the bugs out of my head, but we'll keep going. So let's see. I've been a member of the MTA for probably since 2007, and that's kind of where when I started technical analysis. My experience has been I was the chief market technician for one of the largest independent broker dealers in the U.S. for about 10 years, and with that, it was back in the day when folks didn't really pay too much attention to technical analysis, and especially in the big broker dealer firms, they were mostly fundamental analysis. So my task was to come in and introduce technical analysis not only across the research department but across all its clients, and that the clients are basically financial advisors, and mostly in the U.S. But I think there is some international financial advisors too, and there's a lot. When I was there, it was probably about 20,000 financial advisors, and not many out of that 20,000 even knew what technical analysis was. So my charter was to not only well, first I had to study and pass all the tests for the CMT, but then I had to actually implement it across the organization, and it was a challenge because a lot of the folks there were CFAs, very fundamental analysts, and they didn't really believe in technical analysis. And so what I did is I did like a bottom up approach. I just kept reading textbooks and kept practicing and kept building models and kept back testing and then implementing strategies. And my role is mostly research, but then it went from research into portfolio management. And so it was a challenge to implement technical analysis because they didn't believe. But then the way the broker dealers work is they have these model portfolios, like a suite of different portfolios that the investors, the financial advisors, they give the broker dealer money in the research department and invests it. And so where technical analysis really shined was that I was beating everybody in performance, my portfolio. So I created a portfolio based on my algorithms I developed, and then I implemented it. And it was fun, but it was hard. And so you got to go from inventing a strategy, and then building a portfolio, managing the portfolio, and then all the compliance that goes with that, whatever. It was a big deal. But the way to win that I did win over the majority of the financial advisors was the performance of the fund. And so I basically ran a relative strength fund because when you're running money for financial advisors, they want to beat the market. And so the best way, beat the index. So the best way to beat the index is using relative strength techniques, and they do work quite well. And so I built this relative strength sector rotation model that would generally stay in line with the S&P 500 or whatever benchmark we're using, and then and a lot of times it beat it. And so that was a lot of my experience was building the model, implementing it into a tradable strategy, and then actually rolling it out. So it was not only like I'm like a geeky engineer, right? So I was comfortable building but then I had to market it, and that was hard. So I had to actually interact with people, and I haven't talked to people in a long time. So, but then the end result was I had a number of clients, which were financial advisors, that would follow my work. And so as part of that, you do a lot of outreach where you do daily morning calls, you do webinars, you do outreach via email, and then that builds your clients. So a lot of my experience was investment research, which went into trading, and now I do trading. I do the same thing now. I left the industry about maybe 3.5 years ago, and the reason I did is so I could continue to do my own financial advising to financial advisors. So what I do is I still do consulting to financial advisors, and I do trading, and so I teach people how to trade. So that's kind of where I am. I'm really in the camp now of figuring out how to help people overcome the barriers of trading, and then that's hard. Going from financial research to trading is very hard because trading is a different mentality, and that I still have a hard time doing it too, especially in these markets that we're seeing over the past 6 months hasn't been that good, and so it's a different mentality. So that's kind of my experience. Sorry, I rambled. Prasenjit, I'm handing it off to you.
Yeah, thank you, Dave. I mean, it's always a pleasure to hear you. I mean, your vast experience that you have. So, for me, well, it started back in 2006, like after I completed my MBA in finance, which is the Masters in Business Administration. So, I happened to join a broking company back in India. So, like back then, there was this guy who had this very deep interest in technical analysis and sort of things. So back then I was very young and I did not know what is technical analysis and all of it. I just kind of heard the term technical analysis. Uh, and also it was not a research role that I'm presently in, but that was more of a business development role that I was in. But there was this guy, he was also into this business development and sales roles, but he had very good interest in looking at the charts and the data and all of it. So it was then, I thought that maybe, I mean, even I could give it a shot, right? And I was very impressed by the way he used to look at the pivot tables and look at the charts. So I mean, it was very interesting to me. So that's how I started. And also in my family, my elder brother, they are into financial engineering, so I also had this family background sort of. So well, as I progressed into my career, I realized that if you have to be a good salesman, you have to understand the domain, right? So back then we were selling demand accounts, we are not selling knowledge, right? So uh, what I realized was that it is important for you to understand the domain, right? So I started reading some basic books, and to be honest, I even did not know what books to read properly. I mean, uh, so it was in 2012. Again, I met someone. He was, I mean, relatively good at technical analysis. So he and myself, we became good friends, and we started together to read, even certain deeper books, which is like a Edwards Maggie type of thing. And it was in 2012 only, as far as I remember, I heard about this CFTE and the CMT certifications. And also, like, I was not very sure which one to do and which is better, and which one is what. So, but later on, I thought that either of the two, one, I mean, CMT is the way to go, and this is what I need to take. So eventually, it kept on, getting delayed because I was not able to manage much time for the studies. But uh, well, in 2015, finally, I thought that enough is enough. I need to, move into research. I want to move into research. I don't want to do any more sales job. And so, yeah, so that's where the CMT journey started for me. So I would say that up till 2015, I had some basic understanding about the technical analysis. I had read books from here and there. I had, the knowledge in bits and pieces, but not as a structured formal thing. So obviously the CMT curriculum, after I just completed the level 1, I could understand, the whole universe. I just got a map of the whole universe. So that was very helpful. And obviously, after clearing the level 1, you get excited, and you get motivated to carry on further. So in just I think in 2016, by the end of 2016, I had cleared the CMT level 3, and I was lucky to get sponsors. So I got the chartership as well. And during this phase, I actually got a break into the research team for the company that I'm currently working with, which is a large brokerage house in India. And I got a break into the derivative research stream, and it was more of a data oriented thing. And also we are using a lot of technical analysis. So in my team, I mean, there are a lot of people who are veterans in technical analysis, but then still I feel that they have certain lacunas in their understanding. So what is also here to learn is that you got to upgrade, right? So now in the recent 3-4 years, what I have realized is that there's something called objective technical analysis, which we all have read in the level 3. And David Aronson had beautifully explained in his book how and why this objective technical analysis is important. So so that is the trigger basically. So that's where again I started to learn programming, right? So I started to learn VBA and then a bit of Python, and that is kind of been the journey for me. So yes, so that is it for me. And if you talk about my core strength, basically it is momentum trading is what I do. Yeah.
Wonderful. This is an opportunity for me to pop in and get the ball rolling. And I'd love to invite Chris and Vishwesh. If you have any questions at the top of your mind, I'd love for you both to first just talk a bit about yourself, what you're doing right now, where in your CMT journey are you, and then we can and you can direct a question to either Prasenjit or Dave, or just leave it open for the both of them. Vishwesh, would you like to start?
Sure, sir. First of all, thank you for the opportunity, and it's good afternoon here in Bangalore. So good afternoon, everyone. I am Vishwesh. I have currently I've done my bachelor's in mechanical engineering, and after having a work ex of almost one and a half year, I felt like I need to understand business. That's why I went on to give a CAT, which is an common aptitude test exam, which gives you entrance into MBAs. So right now I'm doing a MBA from Jagdish Seth School of Management, and I've chosen majors finance as my majors. So trading, not only trading but stock market is what that has fascinated me from like my childhood days. Like in my family, my father does, my uncle does this, and we have this background of trading and investing. So like from everyday conversation between elders, I found it to be interesting. Not to be honest, I found it interesting. And coming from science backgrounds and no finance knowledge, uh, I think I thought directly getting into fundamental would be a tough task. That is why I choose technical, because it according to me it doesn't require much knowledge for you to trade. I know it is a ocean, but for to start, it doesn't require that much of that aptitude. That's why I've started this trading. So.
Chris, would you like to quickly introduce yourself, and then we can jump into the questions?
Perfect. Yeah, it's great to be here. I work for a small RIA in New England over in the US, so not too far away from Dave. Been there for a few years. We're a long only firm, so people haven't been doing too much technical analysis there. There was one partner that was a point and figure guy, kind of started his career back with the Dorsey right when that kind of came out, and was doing it all by hand. And so he kind of started teaching me. He retired last year, but kind of before the year leading up, kind of would teach me here and there, kind of his strategy and how the point figure charting worked. And then he retired, and then no one was using point figure charting anymore. So I kind of started, taking that responsibility and kind of wanted to take it one step farther to go with the CMT and taking the level 3 in June. But it's definitely been, fun to learn and kind of start slowly and implementing it into our research that we're doing, and try getting some of the partners that might not be great believers in technical analysis to slowly start accepting a little bit. So it's been a fun journey, but great to chat with you guys, and excited to learn more.
Wonderful. I like, Chris, that you've already begun the advocacy work that is at the heart of CMT Association's kind of mission as well. So great. Let's jump into questions. Is there anything top of your mind that you'd like to talk about, Chris, Vishwesh, questions you have that maybe Prasenjit or Dave can help with?
Yeah, I guess I'll start off. That's okay. I guess this is, maybe getting back to, something that you were talking about, Dave, but just kind of, since this is, I guess, very specific to, long only firms, but, especially working with higher net worth individuals, where they're going to kind of very much care about taxes and all that, just implementing a strategy and technical analysis in general into a long only where, it's, I guess the big thing that we always learn about in the CMT is you want a system that you're not kind of changing constantly, right? So kind of how do you implement it where, maybe you have a sell signal, but then that client, might get upset if you're selling something that you've owned because it's been in a trend for 5 years, right? So kind of, I guess, taking both those into account. If you guys have any tips there.
I have a suggestion, and it's well, first off, it's nice to know you're kind of in a spot where I was in a few years back, where you have to not only learn the trade, but you also have to implement it, and you have the barriers of people that don't understand it, and you have to prove it. So, but one of the simplest methods that I think you could implement, it'd be very similar to something I did, is because we ran a long only too, and I think that's kind of the way it is when you're in a broker dealer for the RIAs or hybrid RIAs, whatever. The best way to you could do a test portfolio that you could just use ETFs or maybe mutual funds, but maybe just ETFs because they're a little bit easier to trade, and it would be something that you could rebalance monthly, so it's not churning, right? And the simple mechanics of it are, you could really start off easy. You could say, if that you break down your suite of ETFs by say you want to do a sector rotation, you just do the 11 sectors in the S&P 500, and what you could do is you could look at it and say, at the you set the calendar date, the first of every month, I'm going to look at my 11 ETFs. If they're above the 200-day moving average, I'm in. Okay. If they're below the 200-day moving average, I'm out. And so what you do is then you can adjust to any market. But if you want to really fine tune it, then you do the relative strength. So you do the ratio chart of the ETF to the S&P 500. Same technique. If it's above the 200-day moving average, you're in. If it's below, you're out. And then what you do is you rebalance it monthly. And the way you can allocate it is you can allocate it according to the percentages that are in the S&P 500. So say tech's 26% or whatever it is. Then if you get a tech buy signal, then you're going to probably be around that, right? But if you're doing a relative strength and say it's above the relative 200-day moving average, then you're going to overweight it. So instead of 26%, you might do 30, you might do 28, whatever it is. But the simplicity of it is it's easy to sell. So you can say, this is the model. is either relative strength or absolute. Every month, I'm going to look at these. If they're above the 200-day moving average, I'm in. If they're below, I'm out. And then you're going to allocate it to however you want. And then what you do is you run it for a while, and then they'll see the benefit of it. There's no churn. Most times, if it's above the 200-day, it's a positive trend, so it's probably working. And then the way you would handle the cap gains is, in the case that, for an RIA and you have an existing high net worth clients, they're probably holding like individual stocks that are whatever, been there for a long time. But if you have the ETFs, then it's easy to do the tax stuff. You don't have to, a lot of people aren't going to say, oh, I've been holding XLK, the ETF, for 20 years. I don't want to take it out. You know what I mean? So it's a little bit easy to sell. So that's kind of a simple idea.
Thank you.
I have a question for Prasenjit sir. Sir, as you have mentioned that you've worked in the options or derivatives department, research department, I would like to ask you a question. How can technical analysis be applied on derivative segments? And what is the scope of technical analysis in derivatives?
Well, so for derivatives, like see the term itself, derivatives, implies that the instrument would derive its price from the underlying, right? So if you are able to predict the underlying in itself, so that will do the job. So in derivatives, there are a lot of data sets that are by the virtue of the derivative market itself, there are a lot of data sets. But then the core is the underlying, because any derivative instrument, whether it is a futures or an option, it would not move, or it has a direct correlation with the underlying. Correct. So if you have a good understanding of the underlying, then that is the core. And as such, technical analysis, I don't think so. You can use some kind of a moving. If you call some kind of a moving average as a technical tool, yes, you can maybe use in some kind of a PCR ratio or something like that. But then the whole idea is to be able to predict the spot. So if you're able to predict the spot using technical analysis, then the later part is the derivative. So derivative instruments are just a vehicle, right? So let's say if I get a buy signal on any underlying, okay, so depending on what time scale and the range that I can foresee, I would choose the derivative instrument. So maybe like I can just straight away buy the underlying and equity itself. That's basic. Second, I could just go long on the futures. Third is that I could buy a call. Fourth is just like I can write a put option, right? So there are 4 ways to play long or go long on the underlying if your view is long on the market. So the core idea is to predict the underlying. Correct me, Dave, if I'm wrong.
No, you're absolutely right. That's the key. You understand the underlying trend, and then the options are tricky because a lot of times they're more shorter term. I was talking with Chris about more of a longer term strategy, and so if I was gonna do options, that would be my strategy would be different. It would be more shorter term.
Absolutely. So it is important, like what Dave said, that typically when you are using derivative instruments, it's like very ultra short term. Either it's maybe for just over a fortnight, or maybe 5-6 days, like the way I do it. And then obviously intraday is what you can also use the instruments. So these are like the vehicles. So first you have to
One
know
thing I
which
also
way you
want
want to
to
go. Yeah.
No, absolutely. That makes a lot of sense. And thanks, Prasenjit, Dave. I think both of you make some very, very salient points. And one thing, Vishwesh, I often try when I speak with folks to kind of talk about is the fractal nature of technical analysis. Right? Technical analysis works across time frames, whether it is the ultra short term, like Prasenjit was saying, or the medium term,
Absolutely.
like think in terms of few weeks to even maybe a year, and the long term, looking at even business cycles of 20 and 30 plus years. I think the key criteria for technical analysis should not be what kind of instrument you are trading, but are there enough human beings trading it? and then it can be anything, including but not limited to cryptocurrencies, which everyone knows these days. Right? So the idea is to think about not does technical analysis work in asset class A or market B, geography C, but are there enough human beings getting together, and only when that condition is met does technical analysis begin to really come into its own. So I
Mass
hope that kind of
psychology,
makes sense. Yep,
mass psychology has to come into the play.
that is true. That is true. But okay, those good questions though. I'm glad you asked.
Thank you, sir.
Next question, guys.
Yeah, I'd just love to hear how you guys have been, thinking about maybe the past year or so, and just kind of if you've changed anything with, how you're investing or, advising people to invest, or, since there's been so much kind of, I guess, noise kind of coming from outside of the internals and everything that's going on with the Fed. I'm not sure if that's kind of changed your thought process since it's coming off of like 12 years or so of kind of steady low interest rate environment. If that's changed anything for you guys.
Well, for me, I think I would say that not much, because every time market will have a different reason to behave the way it does. But nevertheless, the core principles of technical analysis would remain the same. So if we have we all are like model based guys. So as long as the model is within the tolerance level of performing, there is a performance curve for the model, right? So as long as it is within that the acceptable limit of the variation in the performance, I think we don't need to fiddle around with the model. And as I said, every time if you're pointing towards the Russia Ukraine war, then yes, obviously it induced a lot of volatility into the market. But then yes, that is the inherent part of the market. I mean, every time we'll have a different reason, and markets are going to apparently look like now this time it's different, but it's not. So generally we prefer to stick to our models unless and until there is drastically something wrong. That's
Yeah,
my thought.
I agree with that. I think one of the key pieces of technical analysis are as part of you building your model, and that's your plan, your game plan, your overall plan. You have to have rules, right? And so as part of the rules of like a model I would operate is I would look at the overall trend of the market as my guide. And then as part of that, then you start building your allocations. So say, for example, you're in a long only portfolio and the market's trending lower. And the way I do that is I look at you guys already know I do relative strength. So I look at the ratio of stocks to bonds. Okay. And so if bonds are outperforming stocks, usually the market's in a downtrend. And so you have to implement rules that will say, okay, if bonds are outperforming stocks, you do one of two things. Either, overweight bonds if you want to stay if bonds are working, or maybe you're sitting on the sidelines in cash, right? And so as we go through the choppy market of the past, whatever, year or two, I don't even know, there was a lot of times when we would be in risk off, which would be a downtrend. And there were times it would be like these bull rallies, risk on. And so based on your time horizon, like Joel talked about, technicals are fractal. Based on however time horizon you're investing in, you would adjust to whatever that trend is. And then that's how you would allocate. So if you just operate off your rules, then you kind of can, like we talked about this on last call, you can kind of not listen to the market and not listen to, you have to listen to the price charts, but you don't have to listen to TV, right? And, yesterday was weird because we had in the US, Powell was speaking, and as he was speaking, the markets went they started off good and they went like this, and then they just tanked, and I mean, that's not tradable for people over the longer term. It's you can't just sit there and go short the Qs or whatever. You can't do that. So I think if you stick to your rules and you have a good plan, the whole idea is to stay with the plan. And then when you have a good plan, that takes a lot of the emotion out of it. So if you know that I'm dumping the stock if it breaks this level, or I'm adding to the stock if it breaks this level, that makes things easier. Because trading's hard, and you'll always second guess yourself. But if you have your rules and you follow it, it makes it easier. So then you can take away Fed speech and all that.
I just wanted to add one more point to this, like the context of building a model. So, like a lot of people ask me, what moving average do you follow? What indicators do you follow? Which candle, time horizon should I follow for a long range prediction? What should I do for intraday trading? So, my answer to people who think about model building is that generally people I have seen what they do is especially if they have the ability to crunch data, they would firstly pick up a bunch of technical indicators and they would like torture the data hard enough to come up with some kind of a number which looks good on my Excel. So this is not ideally what I would recommend. The idea should be to first come up with the with a logical premise. So one should first think about a phenomena that we want to trade. So say for example, in Indian markets, what I have observed is that uh, the moment markets open, like we do not have a 24/7 market, so there is a closing time and then we reopen the next day. So what happens is generally during this gap, a lot of information would come and markets would automatically try to adjust to the new information next day, right? So in the opening few minutes, I have seen that market would quickly move in a particular direction very quickly within the 5-10 minutes. So and that's like a unidirectional move most of the days. So that is a typical phenomena. Now if I want to trade that phenomena, then I have to first understand why this is happening. So I have to figure out why such a phenomena is there in the market. So let's say if the logical explanation is that there are a lot of people who do the research in the evening, the whole night, the early morning, and as soon as the market opens, they would just try to come up with their pre-decided orders and just punch the straight away the orders that they want to take, right? So because of those sudden order flows, any sector or any particular overall as a sector, if I say that we could see a quick move. So the idea is to find a logical premise, a phenomena that I want to trade in the market which I have observed, and then the second point is, now how can I capture that? So then the question of indicators should come. So if I want to again giving another very simple example, like let's say if my observation is that if a stock price has been into a range, and as soon as there is a range breakout, it would generally be followed with a quick move in the direction of the breakout. So now the point here is that I have to ask myself why this should happen. Okay, so the logical answer is that yes, a range would typically mean that there is an equilibrium. So there is no new information which is coming in, and like prices are moving back and forth, right? Based on the present information. Now, a breakout means that some new information has come into the market, or market participants are expecting some kind of a news flow to come in, positive or negative. So based on that anticipation, the prices would break out. So now if I want to trade this phenomenon, I know that this is a phenomenon which works in the market. So now the second question should come, which indicator would capture this range and the breakout? So that's how like one should take an approach as far as model building is concerned. So when you have a well thought process, like Dave was saying, that you must have a thought process going behind building a model first. So if you have built a model which is based on a solid ground, then probably it will be long lasting, and the chances are that you would have spent sufficient amount of time in choosing the indicators or the tools while designing the model. Because too many indicators into a model, I don't think that's a good idea, because that would be like you run the risk of what is called as a curve fitting, right? So lesser variables, if that can explain your phenomena, that is, I think your job is done. And also, like, not typically talking about the long only funds like you guys, but in general, I'm just saying that in case of like uh, any model that you are thinking to build, whether you are trying to trade some intraday quick moves, or maybe for long term investing or something, uh, the idea should be that pick your indicators very carefully. That's number one. Second, pay attention to the fact that you are not using the similar class of indicators. That would be a redundant one. So that's important, that you do not end up using indicators of the same class. You might be using four indicators, but if they are of the same class, then it's not doing good to the model. So one could be based on price, the other could be based on some volume, the third could be based on sentiments, something like that. So that is the idea behind, so that you are kind of, your model is going to work for you know for a while.
And I
So
totally agree. But me and Prasenjit are both momentum traders, so we trade breakouts, and so that's why we're always most times in consensus.
absolutely.
But a breakout on high volume, that's pretty good, right? That's
Yep.
might be worth something.
Yep.
Do you have any other questions?
Yes. Vishwesh, Chris.
Or should I be the classroom teacher and prod people into asking questions?
I think Vishwesh had a question, right?
Yeah, go ahead.
Yeah, I guess just kind
So,
of. Oh no, yeah. Sorry. Go ahead.
No, Chris, if you have
okay.
something, by all means, please.
So I would like to ask Mr. Dev, like there are some current trends going in stock market, like investing in meme stocks or like ESG investing. So how would what is your view on that? I would like to ask that.
I'm sorry. Can you say that again?
There's some current shift in trends in stock market, like people are like the rise of meme stocks or even the ESG investing. So I want to ask, what are your views on this? Because this
Well,
is a new concept or a thing for a newbie like me. So I'd like to
uh,
ask, what are your
yes,
views?
it's interesting. So, and the meme stocks and the cryptos, and it all comes down to what we were talking about, where um, you have to, if you have your premise or your plan, and say you're a breakout trader, right, or investor, whatever. Technicals allow you the ability to go to different time horizons. So you can do day trading, you can do intermediate, which would be weekly trading, and you can do long term, which would be monthly. The so when the thing that's been a little crazy with the meme stocks is that they're more day trading. They're very short term, and so if you're interested in that, first off, it's not easy, and it takes a lot of practice. So the meme stock, um, I would suggest that you do a lot of paper trading first before putting real money in, and make sure whatever indicator you take, whatever strategy, say you're a breakout strategy, right? So you're watching the charts for some sort of like consolidation, say a squeeze on the Bollinger Bands, and then you watch for an upward breakout, right? Um, then, if you have that as your plan, then you can adjust to how do you monitor that breakout? Is it with a certain indicator? Is it in conjunction a price chart with volume? Is it you have your certain rules. So say like it has to trade over 90,000 volume per minute, or it has to be in a range that's between 3 and 5 points, or the bottom of the range where like the low is to where it is now has to be double, right? I mean, these are big volatile moves that might help you, uh, adjust to that the spurt of the breakout. The But your question is how when you have these different themes in the markets like memes or crypto, or where people tend to be going, that you can just monitor that with your process. So you don't have to be particular to memes. You don't have to be particular to S&P 500. You don't have to be particular to crypto. You just have to have your process, and you have to monitor your process and then take advantage of it. But I think before you start that, really get your rules set and do a lot of paper trading. And then once you're really ready, then jump in. Sorry, any other comments? Prasenjit, what do you think?
Well, absolutely. Paper trading, back testing, these are the basics. And just to add, like, so this is where I personally felt back in 2018. I would say that I need to be able to crunch data in a more effective manner. So I was an Excel man, like right from 2013 till about 2018. But then Excel will have its own limitations. You can't handle large amount of data, right? And you can't do a serious backtesting if you have any strategy or any idea in mind. So that's where I also feel that nowadays, like, Python thing is very easy to learn. You must have some kind of ability to be able to crunch data. So if you have any idea about any indicator, like, it's not necessary that you always have to use whatever indicators are written in the book or whatever you have read in the CMT curriculum. You can think about your own ideas and form your own typical type of an indicator. Like I did myself. Uh, it is regarding market breadth. So I felt that market breadth and sentiment, they are really connected, and looking at the market internals can give you a deeper insight into the psychology of the market participants, which in turn is going to be a leading indicator, could be a leading indicator. Not necessarily that by looking at the S&P chart or the index chart would give you the whole idea about the total market or any particular sector, but rather if you look at the internals of any market, that would give you a better understanding how the market participants are, what emotionally they are experiencing, right? Um, so this was just an idea, like, if I want to understand if people are stuck in the short term trades. Like there is a situation where there was a breakout, okay, across a lot of stocks, and suddenly something happened in the market and all the breakouts are not performing, right? So generally what would happen is that after a point, the smartest of the traders would be out of the trade. They would come out, whether they don't wait for the stop losses to get triggered. If they feel that they have taken a wrong trade and it's not going to work out, they would come out of the trade very quickly. Then the less matured people will obviously wait for the stop loss to get triggered, but they are still the better of the lot. And the third, the typical amateurs, they would actually wait out because they do not have any plan to come out, and when they enter a trade, they really do not have that homework behind, and eventually they end up into a deep loss, right? So this particular phenomena where a breakout fails, there are three layers of people. The smartest one who come out at the first layer without any damage or even with minor gains. The third, the disciplined traders who can come out based on because of their discipline, and the third is the worst bunch of people. uh, so if you understand their psychology, if there is a way to read that, all the people who got into a particular sector are more or less experiencing kind of a discomfort in terms of their positioning, because they thought that the stock would be going boom boom boom, but then nothing is happening. So if you can observe this phenomena, then you know for sure that it is just a matter of time, the smartest ones are going to be coming out very quickly. And the very fact that it is not moving after the breakout, why is it happening? Because maybe the strongest hand in the game is not letting the stock to go up, and there is no follow up buying as such which can overcome their selling. So there is a seller in the market at the breakout or just above the breakout level, and then obviously that selling is so heavy that the momentum traders who are buying the stocks are not able to surpass that selling pressure. So that means there is something drastically wrong about the sector or the market, right? So if you can somehow tap this phenomena, and it's not about one particular stock, if you observe this across the length and breadth of the market, if you're seeing that there was this banking or this IT or this pharma, every sector is more or less experiencing the same phenomena. Every sector had a breakout and now the stocks are not performing. So what is the next step? Next step is that people are going to come out. So it is uh, the fastest finger first. So if you can read this, then if you come out quickly, that's your edge. So this was my core idea, and now what I required was again like a model. So I picked up two indicators to tap this particular phenomena. Then I required the ability to crunch that data. So I took out the whole of data from like about 15 years of data, all the stocks that are liquid, which have a reasonable volume, and I tested my idea and found this to be working, right? So again, like coming back to that model building thing, these are all connected. So you must have an idea and you need to test. So first is the idea, then like the logical premise, and then you need to pick the indicators, and then you need to be able to test. So as Dave was saying, paper trading, back testing, these are very important things, right? So after you would have done your theoretical thing, you have done the thinking part and you have picked up the indicators, then you need to be able to optimize or fine tune. It might be possible that you have actually picked the right indicators, but you have not just maybe tweaking the parameters would give you a better result, right? So that's where the data crunching ability would help, and also it helps you to prepare for the worst.
Yeah, I agree. This kind of sounds crazy, but I actually love doing it. Every Saturday, I think I spend 5 or 6 hours doing data, and that's
Yep.
every Saturday. I mean, it's crazy. And with that, when you do that much data and back testing, you figure out new things. It's fun, right? And then
Yeah,
you
absolutely.
implement it. I love it. But back to your uh, the point about people getting out of trades quick. So a lot of the seasoned day traders, what they do is they'll sprinkle their ideas across multiple asset classes or ideas, whatever, based on their triggers. And if they don't work, they're out quick. So the mentality is minimal losses, and if something starts working, you add into it. And
Absolutely.
so out of say 10 trades, maybe two work, right? So they're dumping 8 and they're riding 2, but that ends up working. So you, as part of your rules, there's different ways you can test. Like if if you want to be a short-term day trader, there's some rules, like say you're reading the 10-minute charts, you get a breakout based on whatever threshold you have. And if it's not working for like 8 periods or 5 periods, you're out.
Time
It's
stop loss.
so say it goes sideways for 5 or 8 periods, you're out. And you do it
Yeah.
again, and it's continuous. But that's a different mentality. That's day trading, right? That's different than running money for a financial advisor. They're not going to want you to day trade. Uh, you have to figure out who your audience is. If it's yourself, I mean, I personally like short term trading, but if it's for a client, no, I can't.
It's not practically feasible, actually.
I think
Yep.
kind of one of the cool things.
Okay, there are a couple of
Excuse me.
very interesting questions,
Joe,
and
Chris
I'm
had
going
one
to.
question. I think I cut him off last time, unfortunately.
Okay,
Uh,
go ahead. So then, Kaizad, will you be able to take a couple of
I
questions
will.
that have come in Discord as
Yes,
well?
I will take that. After Chris's question, there have been a few questions asked on the Discord chat, which we can quickly run through afterwards if the mentors are okay with that.
So clearly, you guys are generating a lot of interest and a lot of curiosity. So great job, guys.
All right, I'll try making this a
Sure.
short question. I guess just kind of learning through the CMT curriculum. It's been cool to see. It seems like you can really go a million different directions. So kind of how did you guys figure out your kind of what worked for you and kind of your favorite way of building a model or investing?
Yeah, Dave, you can start.
Well, I'll tell you, I've built hundreds of models. Most don't work. It was just like, it was my full time job for a number of years, just trying to build something that works. I mean but you have to remember, I was a bottom up approach. No one ever did it. I had to read books. I read countless textbooks and I looked at a lot of how the old traders did things and tried to do it myself. Now you don't have to do it as hard as I had to go through. You can just find a strategy that someone else does and test it. You can do it that way. Um, Uh, so what happens is for me, when you find something that works and you implement it and it's starting to make money, it's kind of exciting, and then you kind of stick with that. But what, as I said before, I crunch data all the time on the weekends, and if I find something new, I'll try it. I mean, I'm always looking for like the thing that's the best, so I'm always doing something.
Absolutely. Chris, just one experience that I want to share. Like when I joined the research team, like as I was saying, um, I was earlier into a sales role, and then when I joined the research team back in 2016, my boss actually took me because I was a data guy. Right, I was good with a lot of data crunching. So now I was given the job of crunching data because my boss had a lot of ideas in his mind, and he thought that I was a good guy who could be used to test those ideas. So the first initial, I would say, 6 months were into hundreds of model building, and as I said, I was not comfortable with coding back then. So I was doing all the hard way into Excel, and I mean I was pretty good, I would say. So I was somehow able to pull off things which normally people won't do that in Excel using if the lens function. But that helped me, into, I mean, I would say that kind of got the momentum going for me into that thinking process. Any which way, I was like fiddling around and experimenting with my uh, ideas that I had, and this ability to crunch data, and especially my job role required me to test various types of ideas which were mostly into short term trading because that's our job role. And we dealt with a lot of derivative data, technical data, barring fundamental data, we looked into every sort of data and tried to figure out what would work for index prediction, or maybe a medium term stock prediction, like for about 6 months, where we can look at a 20 to 25% kind of a return on an individual stock. So that was the idea. But then over a period of time, I realized that my interest area was into very short term trading, which is like within 10 to 12 days, maybe 7 days. That's the area that I want to operate. A quick fire, the breakout thing, and the stock goes boom, 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 3%, 5% in just 1 or 2 days, and I'm out of the trade. So that's what I, liked recommending to our clients. And especially in a typical broking industry in India, there are a lot of people who enjoy doing these sort of quick momentum trades because uh, you have that adrenaline going into your blood, and you feel that rush. So I was doing that, and parallelly what I also realized that it is important for you to observe the market. It's not that you look at only the stocks and see which is going up, which is going down, and you always look at things from the lens which you have. So it is important to give it a deeper thought, what you are seeing, what you're trying to what you're learning every day. Is there any new phenomena that you saw in the market? And if you did see something, so you have to be very observant, like as Dave said, that he does a lot of data crunching every Saturday. So what I understand is that that will help him to you know decipher any new pattern which is coming in into the market, or any new sort of a new perspective into the market. So generally, crunching a lot of data keeps your mind active, and that's how new ideas keep coming in into your mind. Like recently, I was thinking about there is this concept of long build up, short build up using derivative data, right? If there is an open interest, I hope that you are comfortable with derivatives data, open interest. Yeah. So I was thinking that how about looking at the whole of the future and option universe that we have in Indian exchanges, and every day I would just track, build a backlog of the data, where every day how many stock experienced a long build up, a short build up, a long unwind, and a short cover. So if there is any correlation, if this sort of a derivative data has any predictive power, again, like as I said, I am a market breadth guy, so I try to look at everything from a market breadth standpoint, market internals. So I was just trying to you know create some kind of a data log, where after the log is prepared, and then we can do some kind of a data crunching. So one has to be thinking every time. One has to be constantly thinking in terms of uh, what is new in the market, what sort of a new phenomena are you observing, and how can that be tapped. So there was this concept of order flow, yeah, market profile, and there's this concept of order flow as well, which is very interesting. Like you have a bid and a ask, right? So if there is a let's say order coming in, which is always a market order versus a limit order. So if these two orders match, then only a trade happens. So who is more aggressive? If the buyer is more aggressive, then obviously you will have a your price being traded at the ask price, and vice versa. So based on this order flow concept can define every quantity, every volume as a buy volume or a sell volume. So obviously somebody is buying and somebody is selling, but then you can still classify based on the aggression, right? So for example, if something is trading at $100 and versus 101, so 100, 101. So if the trade happens at 101, it is the buyer who is more aggressive, correct? And vis-a-vis, if we traded at 100, then it means that the seller is more aggressive. So like this, you can classify tick by tick every transaction into a buy order or a sell order. So if you look at this data as a cumulative volume, like every 10 minutes, if you're a day trader, so it can give you a lot of perspective, especially when there is a breakout. Let's say if there is a trend line that you are watching, and you believe that it is a very important trend line, and you expect a lot of follow buying to come in, correct? So after a breakout, especially after the breakout, you will want to see a lot of buy orders coming in. So that's where this order flow can help you, right? So these are the things, like it's a constantly changing universe, and there are a lot of things which keep on coming every day. So reading is very important, and also you have to have your own thought process going in. You have to be very observant.
I'm sorry,
Yep.
guys. I'm jumping in because we just have only 2 minutes left
Yep.
for our call to end. Chris, Vishwesh, you are the winners of the week, so first preference still goes to y'all. If y'all have any queries left, any questions, please ask them now. We have 2 minutes. Otherwise, I will ask the Discord question.
I have one questions like how should I move further, like what should use what do you suggest for a person who has just entered the stock market, and how would you like me to move further, like what are things I should do so that I can win this market
Dave,
or beat this
over to you.
market.
Well, well, you're doing a good job. So you've already been winning, right? So that's good. I think when I first started, you have to do a lot of learning, a lot of reading, a lot of testing, a lot of learning, and then you have to become comfortable with with your own indicators you choose. So you know you could have a person that trades off the 50-day simple moving average, and you can have another person that trades off the 20-day simple moving average. Probably doesn't matter, because as long as they're used to their own way, they can probably make it work. So I think you're going to have to explore different things that you can become comfortable with, and you can see on charts or through data. And then just with that practice, it's just a lot of practice. I wish I could say it's easy. It's not. I mean, I've been doing it for a long time, and I'm trying to learn more and always trying to be better. So just got to keep learning.
Nothing goes in vain. Even if
Yeah.
end up into a model which is not working, you learn that it doesn't work, so that's your gain.
Yeah.
Thank you so much.
Chris, last one in case you have something. Awesome, guys. So unfortunately, we are out of time. We are exactly at the 6:30 mark, 6:30 India time mark. So we have a few questions on Discord. Mentors, if I can trouble you all whenever you all are free, if you all can address these questions on the channel in the Ask Queries channels, because there are some really important and really, let's say, uh, informative questions that have been put out there that could benefit the larger audience. So whenever you all have time, if you can provide responses to that, that would be awesome.
For sure.
But I wanted to thank all of you all for joining the call. As always, an extremely engaging conversation, and thank you everyone for joining us today.
Thank
Thanks
you.
so much, guys.
Yeah.
Take
Thank you
care.
so much.
See you.
Bye, Dave. Bye,
Thank
Chris.
you. See you
Vishwesh.
guys.
Yeah.
Bye, sir.
Thank you.